Hi, my name is Robert Kiyosaki and I'm going to share with you my thoughts on smart debt leverage, the path to financial success. Debt. For most people, that one word brings up feelings of fear, stress, anxiety. I understand why. From a young age, our middle class and poor parents teach us that debt is bad. They tell us, avoid it at all costs, pay off your credit cards, save your money. This advice comes from a good place, but it is ultimately flawed. It's the advice of people who work for money. The rich don't work for money, they make money work for them. One of the most powerful tools they use is debt. It's time to change how you think about the word debt. Debt is just a tool. It's not inherently good or bad. Think of it like a hammer. In skilled hands, a hammer builds houses. To really get a handle on your money, you need to learn the big difference between good debt and bad debt. It's not a super hard idea, but it's the most important lesson about money. Not knowing this difference is why so many people get stuck in the rat race their whole lives, working jobs they hate just to pay for stuff they don't even need. Bad debt is when you borrow money to buy things that take money out of your pocket. Anything that takes money out of your pocket is called a liability. It's that simple. When you use a credit card to go shopping or take out a personal loan for a fancy wedding, you're getting yourself into bad debt. That new smartphone, the designer purse, the fancy car, they all come with monthly payments, interest charges, and they lose value over time. They make the banks and credit card companies rich, while making you poorer with every payment. This is the kind of consumer debt that really weighs people down. It's a hole that gets deeper every time you dig with a shovel. Good debt, on the other hand, is the complete opposite. It's the secret weapon of the rich. Good debt is money you borrow to buy an asset. And what's an asset? An asset is anything that puts money in your pocket. It makes you money. For example, if you take out a mortgage to buy a rental property, and the rent you collect from your tenant is more than your total expenses, including the mortgage payment, taxes, insurance, and maintenance, then that mortgage is good debt. The debt itself is helping you make a positive cash flow every month. This idea applies not just to real estate, but also to businesses. If you take out a business loan to buy new equipment that lets you make and sell more products, and the extra profit from those sales is more than the loan payment, that's good debt. The key question you should always ask yourself before taking on any debt is this: why do the rich get richer? It's not just because they have more money to begin with, it's because they understand a powerful concept called leverage. Financial leverage is the art of using borrowed money, what I call other people's money, OPM, to increase the potential return of an investment. In simpler terms, it's using the bank's money to make yourself rich, while the poor, the middle class, are busy saving their hard-earned dollars, which constantly lose value due to inflation. The rich are borrowing money to multiply their wealth at a much faster rate. They're not afraid of debt, they've mastered it. Let's look at a simple real estate example. Imagine you have $20,000 saved up. You could use that money to buy $20,000 in stocks, and if they go up 10%, you've made $2,000. That's not bad, but a financially smart person would do something different. He's borrowing the other $80,000 from the bank. Now, he controls a $100,000 asset. A lot of amateur investors get sidetracked by flashy things. They chase appreciation, hoping the price of their stocks or properties will go up. They speculate. Speculation isn't investing, it's gambling. A true investor, a financially smart investor, focuses on one thing above all else: cash or buy. Following stock where this cash flow is the net amount of money coming in and out of your possession. If more money comes into your pocket each month than goes out, you have positive cash flow. If more money goes out than comes in, you have negative cash flow. The goal is always to get assets that create positive cash flow. You bought a property for $100,000. Your monthly mortgage payment, including taxes and insurance, is $600. You budget another $100 a month for maintenance and possible vacancies. Your total monthly expenses are $700. You rent out the property for $900 a month. The math is simple: $900 in income minus $700 in expenses equals $200 in positive cash flow. That $200 is real money coming into your pocket, month after month, like clockwork. Now, I can hear the nervous voices saying,
"But Robert, debt is risky."
And they are absolutely right. You know, using debt, especially leverage, is like handling fire. It can cook your food and keep you warm, or it can burn your house down. The difference is knowledge, respect, and control. The financially uneducated go into debt without a plan and get burned. The financially educated know how to manage and reduce the risks involved. They use debt strategically and carefully, never recklessly. Managing risk is just as important as looking for returns. The first rule of risk management is to do your homework. Never borrow money to invest in something you don't fully understand. Before buying that rental property, you need to look at the deal from all angles. What are the actual rental rates in the area? What are the vacancy rates? What are the true costs of property taxes? What are the true costs of insurance? What are the true costs of management? The most important thing you'll ever own isn't a stock, it's not a bond, and it's not real estate. It's the thing between your ears, your mind. Your money smarts will decide your money future. Giving $1 million to someone with a poor mindset is the surest way for them to become poor again. They'll spend it on things that lose value, and soon they'll be right back where they started. On the flip side, someone with a rich mindset can start from nothing and build a fortune because they know how to make money work for them. Financial education isn't taught in our schools. The school system is set up to create good employees, not investors, not smart business owners. It teaches you to work for money, not how to make money work for you. You have to take charge of your own financial learning. This is a journey that lasts your whole life. The world of money is always changing. New tax rules, new ways to invest, new economic situations. The learning never stops. Be a constant student of finance to stay ahead of the game. So, where do you get this education? Ideas are great, but they're useless without action. The journey to financial freedom begins with a single step, taken today, not tomorrow, not next week. Today. Here's a simple, hands-on plan you can follow to start changing from a consumer mindset to an investor mindset. First, take a good look at your current money situation. List all your debts. Separate them into 2 columns: good debt, bad debt. Most people will find their list is heavily skewed towards bad debt, like credit cards, car loans, and personal loans. This is your starting point. Second, make a plan to get rid of your bad debt, starting with the one that has the highest interest rate. This is often called the debt avalanche method. A lot of people get excited about building wealth, but then they give up when they don't see results right away. You need to understand that getting financial freedom isn't some get-rich-quick scheme. It's a marathon, not a sprint. It's a long-term game that needs patience, self-control, and always focusing on your goal. There will be good times and bad times. This is all part of the journey. The path to financial freedom is built one asset at a time. You keep doing this, and over time, something amazing happens. The effect starts to build up. One day you'll wake up and realize that the money you make passively each month is more than what you spend each month. In the end, the message is simple. Debt isn't your enemy. Not knowing things is your enemy. The usual advice that tells you to cut up your credit cards and live without debt. You need to learn how to play offense. A powerful offensive move. Good debt.